These are stocks that are kind of risky. They're three times, um, so they're very leveraged, and most of those, this is a bull, so most of them will go up as long as the market goes up. But if something happens really bad, you could lose all your money. Some did really good actually the last 10, 15 years, like SOXL, and that's semiconductor bull three times. And when it started out, it was about, let's see here, dollar, then like 50 cents. And it went for years, never really went down. Got up to $2.50, then a dollar something. And then it kind of stayed stable until 2000 when the COVID started, and it went to about $3. And then after that, it went up to, what is it here? Like $70. It went up to $70 from 50 cents to 70. So that's 140 times. If you kept it for around 12 years without selling it, and then even if you kept it here, that'd be about 80 times. So for every 1,000, you get 80,000. So that's the semiconductors. Then you got fungu. Um, these are Tesla's not included in that one, but it's Facebook, Apple, Amazon, Netflix, and Google. And there's some other ones, but those are the most heavy weighted ones. So it takes all those into account. And when it started in 18, they didn't really go up or down. It kind of stayed around maybe $50 or so. And then it went down to like 21 and then 500, almost 500. And then well, that was COVID actually right here. So that was about 30. And then it jumped up to 400, 10 times at least. And then it went down again almost to the 46 mark. And then it went over um, about almost 700 or just over at the peak. And then it started going down. And today, actually, look at those numbers. They're huge. Um, if you could see the whole graph, today was the day that these stocks went up the most. It's a huge line right there. So if you go weekly, that's how it looks like. So those ones, they're a little bit risky. And then you got Technology Bowl. It started out 2016. Oh, actually more. Really? Okay, let's go monthly. Nope, weekly. It started out in 2009. So it was at around 30 cents and it just kept on going up and up and up until it hits 90. So that is, or even more, right here, 100. If you did keep it, that'll be about 300 times. But even if you sold here, that would be about 30. So that'd be almost 100 times here. Still, but it dropped quite a bit because it kept on going up the last, actually a year and a half or so. And then that was COVID, kind of dropped fast to about $7, and then it went up to about 90. So that's tenfold. Then you get TQQ. These are all, let's see, Nasdaq 100 stocks, so underlying. So the largest non-financial companies listed on Nasdaq, based on market capitalization. So a lot of people get the QQQ, which is really good, but this is triple. So if it goes up, it goes up huge. If it goes down, it goes down huge too. So that one started at about 50 cents, and then it went up to around about 90 or so. So 180 times in the last 12 years. But it did have a couple of downs, like from here, 29, all the way to 8 or 9. Actually, some of them might even go even lower if Actually, let's see, 8, 9, yeah, about $8 were the lowest, and then the last from February last month or so went really down. If you get daily, it spiked right here. It was a little bit, actually not really flat. It was bouncing up and down like crazy here, and then just bounced back up. So that's the um, uh, largest non-financial companies. So that's SQQQ triple. So yeah, now this one, that's retailable. Uh, oh, looks like a doe. There's a horn. The horn looks like a monster. But the retail, what does it? Uh, they didn't do very well the last several years. Uh, let's see why the auto part. The fund tends to overweight apparel, auto parts and services, and specialty retailers, department stores. So this actually is kind of flat. I'm actually surprised that it didn't go down way down. But it started out in 2010, or no, yeah, 2010. That was about $2, and then I don't know what happened. Oh, COVID right there, and then everybody went shopping. So $2, and then it went to 50, almost actually over 50, but around 45 here, and then it went down. A lot of times it goes up and down, and it's very symmetrical. It doesn't happen where it just goes up and down. It's more like a little pyramid. What is that one? Dow Jones. Let's do it daily. And that one is 3 times leverage daily exposure to Dow Jones Internet Composite Index. This index is composed of 40 largest and most actively traded U.S. internet technology and commerce companies. So that's a triple one again. And actually, that started not very long ago, and went $10 and then almost 100, and then it kind of went down and leveled off, and now it's going down. And what is that one? Transportation. That one has like it's kind of wavy. Transportation, that wasn't around very long. Yeah, a lot of the stock, these ones, if not too many people are interested, they just disappear because the administration, even if it goes up or down, and not too many people are interested in it, the administration costs are more than what you're making. So you think if something goes up and it still doesn't go up because the administration fixed costs. Um, transportation industry. Yeah. So that's that one. What's TNA? Small cap ball. So that one went down quite a bit. So that one, exposure to nearly 2,000 U.S. small cap companies as defined by the Russell 2000. Yeah. So that one's another one. Started out, well, that's a long time, about $2 all the way to 95. So that's about 50-fold. If you sold it around here, that'd be still good 20 times in 10 years. Now, mid cap bull. So that one's this one here. And that is exposure to the S&P 500 mid cap index. Currently invest in swap agreements and futures contracts. Okay. And then this one is Ultra Pro Russell 2000. So COVID hit here. It went crazy down. So a lot of these triples do way better than the shorts because most of the time the market goes up, not down. So the bull, if you're gonna do it, a lot of times bull is good, but you could make way more money if this happens right here on a short, but it doesn't happen very often, and it happens really quickly, and sometimes it might go up and down a lot, like here. I don't know what happened here, but that's crazy. 90 to 125, that's 30-40% swings. But lately it's not been doing very well, and Russell leverage, Russell 2000 market cap weight of 2,000 U.S. companies, primarily the small cap segment, includes mid cap and micro caps as well. So that's URTY. And this one is Ultra Pearl mid cap 400. When COVID hit, it went to almost $3, and then it went up to about 40. So tenfold. That's another one. Like Montreal Micro Big Oil Leverage. That's a new one, I think. I'm not sure. I'm not gonna go into that one. ProShares. Oh, that's a S&P 500. So that's a cool one. Let me see here. It's been around for a while. 2009. I think after the mortgage crisis and stuff, that's when they started it. And there was $1.50, and then it went to 71. Then I think about $100, and then it started going down. So these kind of stocks, I don't know. They're not, a lot of them, they're not long term, because sometimes they could crash a lot, and they're not very stable. Especially the ones that are actually not bull but bear ones. Those are not good to keep long term. Exposure to S&P 500. The 500 underlying companies are some of the most well-known firms in the world. So this one's okay to keep, but I wouldn't keep it forever. One or two. But from 2009 to around to COVID for 11 years, it did awesome. And then COVID started, and then did great again. But I guess you would just buy the dip when it goes below here, touches the line on RSI or MACD when it goes really low. Okay, next one. What is that one? Oh, regional banks. Ooh, that's not a nice graph. Let's see what it says. Leverage bullish exposure equal weighted index, US regional banks. And what is that one? Daily industrial. Industrial one. So again, there was COVID here, about $8. Then it went flat to about 83. Aerospace and defense. That was kind of flat. Then you got S&P 500. I think that's another one, but different company. COVID 16, then 144. So that's like 8 times. Oh, and that one is biotech. And biotech went crazy down. Kind of went up, and then not too many people interested. So a lot of these biotech companies, I guess, they're not doing very well. South Korea Bowl, how are they doing? Again, big swings, and now it's kind of flat for 2 years, going down. Ultra technology, yeah, technology. What do they have in there? I think that went crazy the last couple of years. Oh, that's only 2 times. Technology sector index daily leverage reset. IT services, software, communication, equipment, technology. Yeah, the last couple of years was crazy. So this is 2007, really. So they had it for a long time. So they started at 230 and then went to 71 cents. And then it kind of crept up slowly, slowly, slowly. What is that, 2015? Oh, that's when they had the market crash in the morning. That was the craziest time. Went 20% down, but this went way more than 20. So it went from $2 all the way to almost $5 or $4. That was crazy day. I remember that. A lot of them were 60, 70% up. The triple ones. Went down and then up within a day. It was just crazy. Just the market itself was 20% down, and then if you woke up that afternoon and looked at it, it's like nothing happened. It was crazy for 3 hours. I remember that right here. And what day was that, anyways? August 15? Yeah, maybe. Or August 24, 2015. Yeah, I remember that day. That was a crazy day. A lot of people lost money because the stock market went down 20%. And I guess if you got some kind of stop on it, it would sell it. But it wasn't good to sell it because within 3 hours it went back up again. By noon, everything was fine. So the lowest was about 70 cents, and it went up to about 70. So what is that? 100 times? Yeah, 100 times in about 14 years. But then it went up and down, and 73, and now it's half. That's oil. Gosh, these are not good because a lot of these oil companies, they're cyclical, so they go up and down. And if they go down too much or up too much, doesn't matter if you're on the bull side or bear side, it goes down to zero, basically. So if you go daily, yeah, see, that's when the oil kept on going down, and then it just, yeah, it's not a good one. What is that one? There, Dow 30. About $4, and then it went up to 80. So about 20 times, but it did go down to 15 here. As you see, when it crashed fast. The reason for this is to everybody these days has their stocks on their cell phones. So it's 24/7. So if something happens, the market really overreacts. It could be both ways. And then it's not like before. Uh, it just goes right down. Same like today, right here, daily. Something was said, and within seconds, the stock market went up $4 trillion. That's huge. That's the biggest, I think, in the history. Right there today. Yeah, crazy. So it went from 60 to 76, 23%. Nail. That's a very interesting one. Um, yeah, it's cyclical, very cyclical. And its sways huge, like $5 to 114, then 23, 84, 40, 150. Like it goes crazy, and then 40. So if you can't stomach the up and downs, this is not the one for you. And that one is policy exposure to Dow Jones US Select Home Index. Firms, home construction, furnishing, fixtures, home improvements, things like that. So this one is it is very interesting because it's very cyclical. But if the tariffs from China come in, I think this is going to keep on sliding down. We'll see what happens. But it's very cyclical. Yeah, from like $7 to 116. It's crazy. Within 2000, in a year, this one, 2 years. Robotics. Yeah. What is that one? Ultra QQQ. I think it's just double that one. So it's not as, let me see here. It's not like TQQQ. Yeah, D is for double. So 2 times. Let me see here. ETF 2 times. Exposure to 1-day holding period. The NASDAQ 100. And it started around maybe $2. Then it went to 90. Then down and up again. So those ones do fairly well because it's the biggest 100 companies, and usually those companies are doing very well. So over long term, as long as nothing happens, it goes up huge. But when something happens to the market in general, then it goes down. So these are all kind of risky. They're not stable. What is that one? 100 double Pro. Represent 100 largest. So it's similar to that one. And that one's financial. That one's crazy, but they started after the financial meltdown. Before that, it probably goes to 0. But it's like 40 and then went to like $1. Then kind of went up to 11 and then it went down to like here $6. Kind of kept creeping up until it hit 105. So if you picked it up at $2, 105, that's 50. So that's like 5,000%. And then within a week or two after COVID, super reaction and just went down over because everything's on people's fingertips. They just overdo it. It's like diving off a board and then go down the water and then you go up again. So that's what happened right here. And it went down to 15 to about 150, tenfold within March 20, 2 years, not even because that one's here, within a year. Then it kind of went down. And then here, since February, not good, but it rebounded huge today. As you can see right there, it's huge. And yeah, what is that one? That's the Chinese one. Is it Chinese? Yes, China Bull. China wasn't doing very well the last couple of years. Yeah, they weren't doing very well at all. What's in it? Large cap. Yeah, 50 large and liquid names traded on the Hong Kong. Yeah, Chinese was not doing very good the last couple years. From 15 to 55 here, but then they got killed here. What is that one? Emerging markets. Yeah, that one's not so good either. Covering 85% of the market cap in these countries: China, South Korea, Taiwan. Yeah. What are these ones? Bank of Montreal, big banks. I guess that one's not doing good either. When did that start? Oh, COVID. Well, went down. It's kind of flat. Didn't move at all. At $12, and then it went to around 60. So that's about 400%. And then down Mexico. Mexico did very well after COVID. That was a really nice stock. Actually, Mexico was doing very well. Huge companies there. So when COVID hit, it was about $4. Then went up to 17, 18, and then it went up to 30. So that's almost 8 times. And then it kind of flattened out here at 11. So what does it contain here? Let me see. Mexico IMI 2550 index, market cap weight index. Okay, yeah. short-term tool, it says S&P 500 2 times. So as long as the United States stock market is going well over time, this one should do good unless you get some really bad downturns. But from 33 to about 100, but this one's only 2 times. That's oil, I think. Dig. Ultra energy. Or energy. What kind of energy? Energy sectors. Oil and gas companies. So that's dig. When COVID hit, it went down to 7 and then stabilized at 40. What is oil? Natural gas. Oh yeah, natural gas really crashed. See, things like that, it's only one sector, and if that sector blows up, it's very super risky because it's not all the big companies in the United States. It's just one sector, and one sector blows up, like here from there, it goes down to basically zero because it's triple. So 41, 105, yeah, I think that's what it is. Natural gas. Yeah, natural gas index. Nugget. Same with that. It's one sector, not like the S&P 500. 2 times leverage on gold miners. So the gold stocks, I think, gold miners. Yeah. Again, when something goes wrong, it just keeps on halving until it goes basically to zero. Very short term. This thing is a couple months at most. It changes a lot. So from 24 lowest to about 60, yeah, I wouldn't do anything with those. What is that one? S&P 500 too. So these is a little bit different. It has everything inside of it. S&P 500, not one sector. And was about 88 cents. Over here is $3, so it went down. So that was 2009. So 70 cents. Now it's 20 and 21. And that's 2 times. What is that one? Bull energy. Again, one sector. What does it do? Dominant energy sector. It doesn't tell you which one, but again, it's one sector and it's kind of risky. It went from $7 to 68, and that's 2 times. If it was 3, it would be more. Real estate fund. So it kind of went up and then down, and then it's going down again. Let's see here. What does it contain? Large cap segment of the U.S. real estate sector, defined by GICS. So that's the real estate. What's block? Transformational data sharing ETF. I don't even know what that means. Is it data centers? Let me see what it says. Data sharing technologies, blockchain technology, blockchain. Tries Bitcoin, peer-to-peer. So things like that. 14, 50. Started 2019. It's kind of, what is that one? China Internet Bull. Ooh. I guess when they started, the Chinese government started regulating more of the firms. I don't think people wanted to invest because it went from huge to almost nothing. 25, then went 55, 28 to 50, and then down. So this is very short term. Yeah. And that one, crude oil, again, when it's one sector, when it goes down like before, it's killed. Let's see, CLU. Cloud computing. Software over the internet, subscription. Earns more, firm that earns more than 500 million from those actions. Probably like Microsoft and Amazon. Here, I think these are all the medical stuff. So it went from about $4 up to 125 in 10 years. And now went down and up. And what does this contain? Yeah, J&J, Pfizer, Merck. Yeah, so these are medical pharmaceutical companies. Cure 3 times. QQQ, that's just normal. It's that one overall, because that one it's not leveraged. There's a TQQ, that's 3, and there's another one that's 2. Most established actively traded ETFs in the world. Listed on NASDAQ. A huge tech exposure. Not a tech fund. Let me see. Huge name recognitions for the underlying index, the NASDAQ 100. In all, QQQ delivers a quirky but widely popular mashup of tech growth and large cap exposure. So it's NASDAQ 100. What you see, I guess you would have to invest all the time, because if you invested here in the bubble, tech bubble, 2000, you'd have to wait 16 years to get your money back. But if you invested every month, then you'd be way up, because as it goes down, you still invest, and then it goes down. But for 16 years, wait, 2000, just before, and 16 years. Yeah, that's a long time. 16 years you would have to wait, and it kind of got flat here. People were scared to put money in, and then it just took off. So it was about $20, and now it's over 500, and then it went up again. Actually, today was a huge day for them. Yeah, you don't see a tick up that big like today. That was the biggest tick out of any time. It's huge, from 415 to 466. It's kind of seesawed here. Big swings right here, and then a giant swing. Okay, what is that one? Vanguard. Again, that one's not triple. A lot of people have that actually. And how old is it? Oh, it's not very old. Started at 18. Yeah, so VF. Not sure what that is exactly. Then there's QQC. NASDAQ 100 Index ETF Canadian unit. So I think that'd be Canadian companies. Oh no. It's in the space, namely the NASDAQ 100. So it's the same thing, different company. 1732. Well, that was established not too long ago. And that one is Spider Select Fund. Fund selected from the S&P 500 small mid-cap exposure. It's again different, I think, company. But that was around for a long time. 2000s, never really did anything. Yeah, then went down, and then it started going up slowly from 18 to there. SPY, I think that's one of the most popular ones. It's been around for a long time. It started in 93 at around $45, so now it's 55. So in 30 years, went up about 45. Where's 45? Right there, that's tenfold. So maybe to 15 times. Maybe held it. But as you see, it went up, down, up, down. So from here, 97 to 12, that's 15 years. It stayed pretty much the same. But if you invested going down and up, you'll be like, if you're here, you'll be like up here, and this will be like way up here, because you're investing when it's going down here, up here. Actually, if you invest all the time and it's going down, you're getting better deal every time you're going down. Because if it was just going up and you kept on getting it, you wouldn't get as much as if it's going down, because you're getting it lower at the price, and then that low part will be the higher part later on. So the best is to invest monthly, same amount all the time, going up, going down, and because if you invest here and here and just held it, it would take a long time to get it back. So let's see that one. I guess you call it the averaging costs. What is that one? Utilities. That one's kind of flat. And this one, S&P 500 ETF. Very similar to the other one, to SPY. Different company, probably ETF. So $8, $56. Global X. What is Global X? I'm not sure exactly. Vanguard S&P 500 Index. I think that's a very popular one too. So it's not leveraged. 46, 150, so 300% in 10 years or so. Yeah. And that one, India Bowl, kind of up and down. It looks like it's at the bottom now. I don't know. Right here, right there. We'll see. That's Vanguard again, S&P 500. Started out at 25. That's about 100. It was 150, so that's 600% in 12 years. Why is that one different than the other one? Tracking the S&P 500, largest 500 companies. So overall, the United States market did very well the last 15 years or so. And that one's China. Spider is in China. We're going to invest in Chinese shares. All markets and cap sizes. So it kind of didn't go anywhere at all. Kind of crashed in 2008-9. Went up and kind of recovered a little bit, but engineering markets kind of stayed the same. China Internet ETF, didn't do very well. Wind energy, interesting. $5, 23. Pure plays in industry. Top 5 pure play companies. Then we got energy momentum ETF. Oh, that's the second stock that Warren Buffett has for people that can't afford his other one, which is I think 700,000 or something now. But if you look at it, okay, that's only 96. So 16. From about here, 2007 to 13, 5 years, it never really went up anywhere, flat. And there is no, let's see what it gets, 23%. 22 went down a little bit. There's no dividends, so yeah. And then it kind of very steady up. Then again, about 2 years, very flat. Even COVID went down from 226 to 170, like 50% down. Shares TSX 60. That's another one. ETF. Okay, that's Warren Buffett's big one. It started in 1978 or 9. It was $300, around $300. But this is interesting. The biggest money was made in the 80s because look, from 300 to 8,000 in 10 years. 10 years? Yeah, 10 years. That's huge. Let's see, 300. 3,000 would be 10. So this is 20-fold in 10 years. Then it went up a little bit, and then kind of 2000 to about, stayed pretty flat for 10 years. So most of the money was made early 80s, is VC. So that's very lucky. As you get more money, it's harder to invest again. And then, what was it, 2009? So 2009, about 4 years, stayed the same again. So 10 years stays the same, went up a little bit. And then, what is that, 200? And then it stayed kind of, went up and stayed flat about 2018. So 2 years about, then went down a little bit, like 50% here. 340. Yeah, maybe 40%. And then it took off. So it took off from 220, 266, almost 300% in the last 5 years. So Warren Buffett did very well. But the most, like I said, the most was made in the 80s. I think Coca-Cola, he kept Coca-Cola because it was like $1 or something. And the dividends are 3%. So I think Coca-Cola is 70 now. So if he got it at $1, that means every year he gets more in dividends than what he paid for, because it was $1 and he gets $3. So he gets like 300% on that stock every single year now. What is that one? I'm not sure what that one is. Oh, that's silver ETF. So, and that one's oil energy. So it's a short actually. So and VIX, yeah, every time VIX goes up, the stocks go crazy. That was COVID. Where's 2009? Right, actually 2008. And then I don't know what happened here. That was last year. And then now. And I think that's it. There's some other ones, but I think they're not there anymore. So those are the leverage 3 times bull the ones, yeah, technology or semiconductors went a lot up and down. But the ones that did well, I think, is TQQ overall. That's a good one. Fungu, there's only a couple of them in there. That did very well, from 50 to to like 700. Actually, it was like 46, 45 to 700. That did very, very well. Same with this one. That thing was 24. Went to 400. Yeah, I think the lowest was here 25 or 20. So let's say 25. So even if you sold at 250, that's tenfold. And then it went down again because there's very little. There's 5 of them in there, I think. So that makes a huge difference. But today they're very happy. It's one of the most up at 40%. So TQQ is good. That one's alright. Fungu's alright. Retail, no, I wouldn't put anything in there. I don't know. Yeah, the last, I don't know, 5 years or even longer. Let me see here. From about 10 years. Retail's not doing very good. With Amazon, eBay started it a little bit, Amazon, and then fast fashion killed it. So there you have it. These are the bull 3 times leverage, and they did very well today. This one would actually 50%. Another thing is when you look at it, this looks like huge, but that huge mark a little bit here is like 42.70. That's like 40% up. But this little mark, and it just goes up a little bit, that could be 100% because from 3 to 6, that's huge. So that little move at the very bottom is much bigger than the move at the top because the numbers are so small. So you got to watch that too. That's why when you look at daily, it doesn't look very big, but it is big because it's not at the very top in here. Because at the very bottom, if it's like even here, when it's like 35 cents and it goes like $5, it's huge difference. But you only see the top. It looks like it went crazy, but the lower it is, the crazier it is because those little lines, they mean much more than these lines because it's so low. And today, even though the line kind of doesn't look very big, it's 54% up. There you have it.